Spyros is a professor of economics at the DIRDI University Business School and director of research at the Department of Economics. His research interests include decision theory, game theory, experiments, and finance. His main research focuses on the role that uncertainty, information, and bounded perception have on single and multi-agent decision-making. Previously, he was associate professor and head of Department of Economics of City University of London. Between 2007 and 2018, he was first a lecturer and then an associate professor at the Department of Economics at Southampton University. He received his PhD from the University of Rochester, his MSc from the University of Warwick, and his BSc from the Athens University of Economics and Business, all in economics. Spyros.
Thank you. Well, thank you very much for the invitation. So the talk is going to be about information aggregation with AI agents. I may be using some economic jargon. If you don't understand something, please just stop me. I'm trying to reduce it. So basically, what is this talk about? So obviously, probably you will, everyone will agree that we're simply moving beyond the era when AI was simply a chat box, right? So now we have what we call the AI agents, and at the present situation, what we have is an LLM plus tools, right? So we give a prompt, the LLM, so the large language model, understands what we want to do. They can invoke different tools, let's say computing or designing or fetching information from the internet, or even working on your computer and changing your data. In the future, it might be buying or selling stocks or buying a ticket for a trip. So basically what they can do now, and this is only going to be more complicated and more complex, is that they gather information about what's happening now. They can reason what to do given the prompt. They can act by invoking the relevant APIs, and then they can evaluate whether their action was successful by observing a new state. Okay, so the question about what I'm going to be talking about is this particular question is, how well can they reason about the information of others when observing their actions? So this is sort of a fundamental human quality that we take it as given. So when I observe somebody doing something, then I can infer about what he knows about something which is of common interest, right? And this is also a basic question in economics and finance. So I think sometimes because we think that AI or LLMs are very good at some things, we also immediately assume that they're going to be very good at many other things that humans are good at, right? But this is not always the case. So the purpose of this, of the research that I'm doing, is to sort of measure and understand this thing. Okay, and I argue that this is a fundamental quality in environments with more than one agent, whether these other people are humans or AI, because now we're going to sort of interact a lot with these AI agents. Okay, so, and I'm going to talk about this in the context of a market, because this is what economists are usually doing. So suppose that we have a market where every player is an AI agent. So the question is, okay, can they infer information by observing actions? So this is the main question. So can they handle complexity? So as I make this interactive reasoning more complex in the way that we humans consider it to be more complex, are they going to be able to solve it? Are they going to be able to reason about others and what they know and what they know they know, and so on? Do market rules change the behavior? So are markets robust? So I'm going to talk a little bit about what are sort of some fundamental properties of markets. And do they learn from the past, right? So this is also something important in computer science, that there are papers that are talking about how LLMs can optimize by giving them some prompt, some task. So they reply, and then they tell them, okay, this is how you did well or not, this is what you did in the past, now re-optimize. And in some cases, they can actually become better with this feedback. Okay, so why study information aggregation with AI agents? One is, as I said before, it is a basic human quality. It's not a given that LLMs are trained to do it. And if they're not, I think we should train them and measure how good they are. In the context of financial markets, this is very important, right? Because this is one of the basic, let's say, properties of a financial market. Because maybe you've talked about, maybe you've seen or you've heard about the issue of market efficiency. So one of the main properties of a market is that the price aggregates all available information. Right? So if I want to buy something, I can see the price. If the market is working well, then this price is the best price, combining any information that's available in the market. Right? So I don't have to be an insider in the market to actually know whether to buy or sell. I just have to trust the price. And prices are very important because they guide all of our, a lot of our choices, right, as consumers and as producers. So if the market works well, then that's a very good thing for the society. So the question is whether, now if AI agents are participating in this market, whether these financial markets are going to work well or they're going to be drifting away in a bad equilibrium. And a special type of a market is called the prediction market. Maybe you heard about this before. So prediction market is a market where we leverage this property, the second property of the efficiency, to actually try to predict things about the future. So how do we do that? I'm going to explain a bit more later. But basically the idea is that we aggregate, we combine all of the available information through prices in order to predict, to have a good estimate about the future. Okay, so this is a prediction market. Maybe you heard about poly market. So this has become very famous the last couple of years. So this was a market that was trying to predict the U.S. presidential elections, and it became very famous because actually, so basically, it's a market that has a question that has a binary answer, right? So is Trump going to be elected? Yes or no? So it has an objective answer, and it is a yes or no answer. So basically, here you have two markets, one for Trump and one for Harris. So this became very famous because I don't know if you remember the market, but initially, the professional forecasters were sort of saying that Trump and Harris were very close odds in terms of being elected. But at some point, the prediction market, the polling market, sort of spiked in favor of Trump. And people were saying that, okay, maybe this is insider trading or something like that. But actually, it turned out that it was the correct choice. And not only these markets were better than the professional forecasters, and also better than the polls. So the polls is where you ask everyone to give their opinion about who's going to be elected. But this prediction market is also better in predicting the individual states where Trump is going to win. Right? So it was not like luck. Okay, so this has prompted a big explosion in people who use actually these prediction markets. They have been around for many years. They have been used in companies like Google and Ford are using them internally to predict things that they care about. But these are sort of public prediction markets where everyone can participate. Okay, so the volume has been increased a lot from 1.2 billion in 2024 to 444 billion in 2025. And there are some studies which show, so for example, this one says that poly market was superior to predict the presidential election, but also, for example, in beating experts. So this is a Federal Reserve Board study, so this is, let's say, the central bank of the US, saying that if we want to predict, so CPI is the consumer price index, GDP is the product of the country, so obviously the central bank wants to predict this every term, because they're going to set the interest rate, so it's a very important variable. So they found that actually prediction markets, like poly market and Calci, which are the most important ones in the US, were better at predicting these variables than the professional forecasters. Okay. So the whole point of this is just to tell you that this is a good sort of tool to provide efficient forecasting. Okay, so what do we do? What's the connection with AI now? So basically, through my research, I've been studying prediction markets for a long time. And what I did now is I said, okay, suppose that now that we put AI agents to trade in this prediction market. So are they going to be good? Can they reason about the information of others? So can we control, can we do an experiment and try to understand, whether they're good or not and what sort of, in which things they're good. Because, one of the issues with LLMs is that they're sort of a black box, right? We don't really know how they behave. It's not a specific algorithm that they implement. So I think economists have a good opportunity to try to study their behavior in economic environments.
So can I ask a question? Mm-hmm. Is there a sense of loss that comes if, in other words, is money being bet, so that there's a loss or a gain if your prediction is good, or is it just that you make a prediction and who cares how it comes out?
In the prediction market?
Yes.
Yes, there is a loss. Yes, so I didn't explain it very well. So basically what's happening is that, so there's a question, for example, is Trump going to win or not, right? So then if you think that he's going to win, you can buy a share of yes, right? So suppose that here when you start, the price is 0.5, right? So if you want to buy, if you think that the probability is higher than 0.5, you're going to buy the yes shares, right? And then you're going to drive the price up, right? So then at the end, there's going to be an objective result. So the number of yes shares that you have are going to pay $1, right? So basically, yeah, so if you buy, then you're risking, so it's basically, yes, it's a bet on the outcome, right? And then, if it goes too high, maybe you feel the probability is lower, and then you sell, and it goes like that. Okay, so what do we do in this paper? So basically, we conduct a controlled experiment with AI agents. So we have teams of 3 AI agents from 8 different models. I'm going to give you what the models are. And so in an experiment, you can do a lot of treatments, right? So the treatment means that you artificially change some feature in the environment, and then you try to test whether this feature, when you switch it from, let's say, control to treatment, whether it has a result. And then we end up with doing 3,500 prediction markets, which is a very high number. And so our sort of hypotheses are based on some economic theory. I'm not going to give you the details. Obviously, I'm sort of assuming that AI agents are rational, and so in this very hypothetical and rational world, this would be true. So the first one is the market efficiency. So the price movements reveal private information until all market participants agree and know what to trade. So basically, this is the idea that when I see somebody buying, I'm trying to infer that he has some good news about the yes share, right? I'm taking this private information that he has, I combine it with my own private information, which may have some bad or good information, and then I buy or sell. So then in the next round, if I buy or I sell, then everyone else observes my actions. They observe that the price goes up or down. Then they incorporate some of this private information that led me to that action. And then this goes on and on. So as the price goes up or down, the ideal is that eventually all of the private information of the market participants is going to be reflected to the price. And the price is going to be equal to the true value of the asset. Okay, and so under some conditions, which are theoretical, there are these solvable markets so that this is going to be true. Okay, so I have until 10 minutes past 4, right? That's right. Okay, so what are the treatment I'm doing in the experiment? So the first one is that I'm varying the complexity of reasoning. Okay, I'm going to talk to you a little bit more about what I mean by that. Then I'm doing this, I'm varying the initial price. This is to test price manipulation. Suppose I have a market and there's somebody who changes the price. So is this going to make the market less efficient or not? Posting public comments, so allowing AI agents to do cheap talk communication. So cheap talk is sort of economic jargon. It means that you're talking, but you're not committing to what you're saying. Strategic prompting. So I change the prompt to the LLMs. I either tell them, for example, you're going to play this game for 9 rounds, and you have to maximize the profits of yourself and your future self for the next rounds that you're going to be playing, right? So then you can be strategic. So, for example, you can lie about your information in order for people to start selling, and then you're going to buy cheaply, right? So you could do that. But the question is whether LLMs have the ability to plan ahead and do strategic planning. I'm changing the number of rounds from 3, 6 to 9. And I'm also giving them a feedback. So this is a treatment where I'm telling them, so I run all of the experiments for 1,700 times, and then I tell them, no, this is the results, this is what works, this doesn't work, now run it again, to see whether they can actually improve. And what are the metrics? So the first one is, the most important is the market accuracy. So basically what I'm measuring after every market ends, I'm measuring the difference between the last price and the true value of the asset, right? So the value of the yes is either is going to be 1 or 0, right? So if the question to the answer was yes, the value of the yes shares are going to be 1, otherwise it's going to be 0. The price of the asset is going to be something between 0 and 1. So as close as I am to the true value, the better this market is. Profits, obviously, yeah. So how many profits the AI agents have, and also trading volume. Okay, so these are the teams that I employed. So I ran this in November, December. So for example, I have the Gemini 3 Flash was sort of the most advanced one, but there were also the GPT 4.0 and so on. So the computer science literature, they have this intelligence indices, and they sort of grade every model when it comes out. So basically they test them in terms of many tasks, and then they come up with an index. So this is completely orthogonal to economics, but I use it as a proxy for IQ. And obviously this is sort of updates every few months because new models come in or new tests come in. So this was accurate in November, December when I ran the experiment. And I had 8 teams that were uniform, so 3 people from the same model, and I also chose 4 teams that were diverse, so different models. And 2 were open weights models, so Quen 3 and Zema 3, the others were closed weights. Okay, so this is the prediction market platform that I have developed through my research grant. So this is where, if I were to run a prediction market with people, this is what you would see. Obviously, the LLMs do not see that; they communicate with that engine through APIs. But basically what they can do is that they have some starting funds. So I gave them £1,000. And then they can buy the yes shares or no shares. Right? And then you can see how the probability of yes is going up or down. And the trading was sequential, right? So you had 3 people, 3 AI agents. They were playing either for 3, 6, or 9 rounds. So either they played once, 2, or 3 times, and they already knew the order. So this is sort of the platform that I'm using. So basically, so you have this LLM provider. So you choose the LLMs. So you have the 3 traders, and then you start generating a prompt. And so obviously, in every round, you have to dynamically generate a prompt which says, you're a trader and this is the question, this has been the prices before, these are the public comments, explains briefly what is a prediction market, and then asks the LLM, what is your, how many shares of yes or no shares you want to buy, give me a private justification, and in some of the markets I also asked for public comments. The private justification is a private comment that will only be shared with the future selves of the same trader. So this was the tool that would allow an AI agent to do a strategic plan. For example, he would say, I'm going to lie now so that you can buy later. Okay, so now let's talk about the setup. So as I said, the important thing here is what? That you have three agents. They want to understand whether the answer to the market question is going to be yes or no. Okay, so the question was, for example, whether this company is going to have profits above 1 million. And the answer to this question depends on three clues. Whether the sales in region A, B, or C are going to be more than 1 million, right? So there are three clues, and these three clues are being distributed among the three agents. So I have some part of the information, the others have parts of the other information, so you have to infer from prices or from actions what the others know to determine whether the answer to the question is yes or no. Okay, so as I make this more complicated, then I can increase the complexity of interactive reasoning that is required in order to solve the market. And I had four levels of reasoning. So the first one, for example, was that I know about sales A, but I need to know whether for B or C it was true or not. I don't even need to reason about all three. The 4, which was the most hard, is the muddy children puzzle. So has anybody heard about this logic puzzle before? Mm-hmm. Okay, so this is sort of a famous logic puzzle in philosophy and also in economics. So it's basically a situation where you have three kids. They can either be muddy or not, but they can only see the other two kids, but they cannot see themselves, right? So there are two clues that they can see, but they cannot know about them. And then there's a teacher that says, do you know whether you're muddy or not? All the kids are saying, no, I don't know, because I cannot see myself. Then the teacher says, there is at least one muddy kid. And then he asks the first kid, and he says, do you know whether you are muddy or not? He says no. The second says the same. But the third kid says, I know that I'm muddy. So this is a case where the teacher says something that it is mutual knowledge, but it is not common knowledge. And this generates new knowledge. So, when I asked the LLMs whether they knew the muddy children puzzle, they all knew it. But obviously, to sort of transfer this knowledge to a market game, it was a bit hard. So, in the end, I didn't do it. Okay? So what do we expect from economic theory is, first of all, that complexity should not matter, because all of these four structures that I have made in a way that if everyone's perfectly rational and sophisticated, they should solve the market in 3 rounds. Distraction should not matter, so letting AI start, setting the starting price, prompting them to be strategic, or giving them more time should not alter the final outcome. So the market accuracy should not change. And also IQ should not matter in the sense that if we assume that agents are very rational, it should not. But as we're going to see, AI agents are not perfect calculators. So these are the results. So this is generated by AI. So I'm trying to explain the muddy children to humans and LLMs. Okay, so what do we find in terms of the results? So one surprising thing was that, so when I'm talking about information aggregation, it's the same thing as market accuracy. So market accuracy deteriorated as we made the structure more complex. Okay, so this was not a given, because what we find as being more complex as humans is not necessarily what the LLM should find more complex, right? But the LLMs read the same things, text as us, so in some sense they may inherit some of the biases that we inherit. There are other papers in the economics literature which are doing similar experiments, and they're finding similar situations where they have the same human biases as we have. So this is sort of, so the logarithmic error is essentially the difference between truth and last price, and you see that as we go to the hardest, the error increases. So the average, in terms of the average error, it was completely wrong, right, in all four structures. If we go to the median, so we sort of avoid the bottom 20-30% worst markets, then they're sort of solving the market, because the first two, they price the asset at 100% when the true value is 100%, so they solve it. But when we go to the very hard, they price at 0.5 when the value is 1, so it's basically the same as random guessing. Okay, the other thing that was interesting is that, consistent with the theory, allowing agents to post public comments, or prompting them to be strategic or myopic, and so on, so all of these conditions did not matter for market accuracy. So that, I think, is very interesting, because it shows that prediction markets are robust to all of these different designs. And especially the issue with the public comments, right? Because imagine that I want to use, let's say, 1 billion AI agents. Everyone is getting different private information, and I want to combine all of this private information to predict something. The most efficient way to do it is through prices, right? Because there's one price, and they can just buy or sell. It is impossible, for example, for 1 billion AI agents to communicate with public comments. Right? So what we saw here is basically that prediction markets are efficient when AI agents are traded. Sort of robustness. Okay, so this is what's happening as I increase the rounds. So you see that from 3 to 9, so there's not a lot of difference, or statistically insignificant difference, but from 3 to 6 there is a bit of a decrease. This is the role of intelligence. So actually market accuracy increases as we increase intelligence. So that's sort of a good outcome, because it shows that as we go to more capable AIs, actually they can solve the markets more efficiently. This is the performance of the AI models so for example, Gemini 3 was the best one, has the lowest error, but it's also the smartest with 46. You see that Claude Haiku was the dumbest. And this is also so the squared error per difficulty and model. So you see, for example, that in the very hard, all of them have high errors. In the easy and medium, they have relatively low errors. Now, in terms of profits, so what did we find? So we find that complexity decreases the profits of everyone. So the market basically hallucinates, and everyone is losing money. If you are smarter, then you get better profits. If you are in a market that everyone is smarter, then you're losing profits. And the trading order matters. So the third trader was the most profitable one, while the second trader gets squeezed. So we saw, for example, that on average the second trader was making minus 90. So whereas the theoretical result would be that he should be making profits. Okay, these are the profits by AI model. Again, the Gemini 3 was the most profitable, and it seems to me that the Gemini 3 sort of came out in November. It was sort of one class above everyone else. And in terms of trading, so trading volume, so we found that when we allowed for public messaging, then trade decreased. So it seems that there was a bit of a substitution in terms of they were able to talk more, maybe reveal some of their signals, which meant they had to, they traded less. If there were more intelligence, they were trading less. If there was more diversity of intelligence, they were trading more. But this is also be consistent with the idea that a smart AI was able to manipulate the dumb AI. They were trading more, and the smart AI was making more money. Okay, so now the feedback paradox. So basically what we did was we said, okay, we run it for 1700 times. All of the results that I presented you, I gave them as a prompt, and I asked them to trade again. And I ran the same thing again, and what we found is that actually market accuracy dropped. So this was a situation where they could not really take all of this, let's say, the cheat sheet or the feedback to become better. Of course, it is a complicated task because it's not a single agent decision task. It is a game, and games are more complicated because I have to understand how the others are going to behave. But nevertheless, they could not really improve. Okay. Okay, so now the last part that I did was the following. So I wanted to ask, okay, so we found that strategic prompting did not have an effect on market accuracy. So this can happen for two reasons. So one reason is because they're very sophisticated, they act strategically, but it doesn't have an effect on market accuracy because this is what the theory says. That's one reason. The other reason would be that actually LLMs are not sophisticated enough to act strategically. Right, so I want to understand whether they had any strategic reasoning at all. So what I did, I tried to sort of dig out any strategic elements from the private reasoning and from the public messages. So I used three things. So one is what we call semantic, sign similarity. This is a statistical measure of measuring similarity between the public and the private message. Information hoarding is the gap difference between public and private message. So if I say a lot of things privately, but very few things publicly, then it means that I'm sort of not revealing a lot of the information of how I'm thinking. And deception, so what I did, I asked Gemini again to read all of the public comments and then classify them in terms of whether they revealed information about the signal, about the clue that this AI agent had. And then I measured the difference between what the judge, the Gemini thought, and what the reality was. Okay, so for example, if you see here, so this is over all prediction markets. So, so these are the public messages. So the public messages have very few words. The private messages have more words, right? So they have some kind of strategic understanding because they reveal more information in terms of their private reasoning rather than the public messaging. However, what we find in the regressions is that strategic prompting has no effect on deception or information hoarding. So again, I was not able to sort of find a causal link, which means that it seems that they do not deliberately act strategically, even if they're prompted to do it. However, the feedback led to more information hoarding, so they took the message that public messages do not really work for market accuracy, and they spoke less after we gave them the feedback. And one thing that was interesting in terms of strategic behavior was that as the market progressed, then they became more truthful. I mean, this is consistent with theory in the sense that as the market ends, there are less information rents, so you can be more truthful because you don't have anything to lose by revealing information. So that was a bit strategic. So I find some strategic elements, but not so much. Okay, so just to finish, so what are the main conclusions, right? So AI agents, or the median markets, they can solve simple markets, but they crash when reasoning becomes more complex in the same way that humans would sort of crash. Intelligence is a positive factor. That's a good and hopeful result because maybe with the new models they're going to become better. Prediction markets are robust because they're unaffected by many sort of design choices, especially communication. So you don't need to have AIs talk to each other. They can just trade, and they're going to be equally efficient. And sort of this is the bottom line to take from that is that they are robust. However, AIs are not yet the hyper-rational traders or superhuman actors that we think they might be. Okay, so that's it.
We've got time for one question and then we'll break out. There's a question.
Thanks for the talk. The generation of models you were using apart from Gemini 3 were sort of previous generations. So if you've got plans to kind of run this on a cadence as new models come to market, what's your thinking around that?
Yeah, I mean, ideally, I would should be running with every new generation, and maybe even grade them in terms of that, right? But it's true that maybe Gemini is a bit of a higher class.
Yeah, because Opus 4.6 would be an interesting one to see how. I'm not saying it would perform better or worse, I don't know, but I'd be curious to see what the results were.
Yeah. Okay.